Hello and welcome to CMC Markets on Tuesday the 29th of October, and my quick weekly look at some of the markets that I'm particularly interested in this week. Now the main focus of attention is likely to be the October FOMC meeting, though I think it's unlikely that we're going to get any major surprises from that. I think the main focus is going to be less about the Fed, though I think we could see some change in the Fed's economic forecast, so it's certainly worth keeping an eye on them. But also the October data that's due out in the coming days, and specifically I'm talking about the ADP employment report, which is due tomorrow and which is expected to show a slight drop in jobs added for October from 166 to 160. 160 does seem a little bit optimistic, but that's the estimate figure. More importantly than that is the ISM data, the manufacturing data, which is due out on Friday. And once again, I think markets are being slightly optimistic about the decline in that. The expectation is for it to fall to about 55.2. Now, given the fact that we've seen a very significant decline in US consumer confidence for October from 80 to 71.5, that maybe does suggest that we could well see a significant drop-off in economic confidence and a significant drop-off in retail sales as well. Retail sales for September came in at minus 0.1 when you factor in autos. So that does seem to suggest that the consumer is already looking at reining back their spending even before the government shutdown. And if you think that there's a possibility that you could actually get furloughed in January or February, because that's really all we've done is we've deferred the problem until then, I think US consumers are going to act as a significant drag on GDP in November and December, even if you take into account Thanksgiving, Black Friday and Christmas as well. So how does this affect the S&P 500? Well, as you can see from the chart in front of you, that's up 27% this year. So despite the fact that the US economy is starting to show some signs of weakness and is likely to continue to do so into Q4, that's really not too shabby. But it's also not altogether surprising given the low interest rate environment that we're working in at the moment. Having said that, you've got to really ask yourself, a 27% gain so far on the year, how much further upside is there? Could we see 1800? Let's not forget that we're heading into the Q4 of this year, and Q4 generally tends to be fairly positive for stocks going forward. You've heard of people talk about the Santa Claus rally. Now personally, I'm a little bit skeptical about that. It just makes a nice headline. Having said that, we can't rule out potential move to 1800 given the amount of stimulus that's sloshing around in the system. It's also a very big week for earnings. We've seen Apple's latest earnings come out with a massive number of iPhones sold, as well as iPads sold, and we now have met our target, our breakout target that we've been talking about for quite some time, as can be seen from the chart in front of you. So as you can see from the chart in front of you, we've just about made our target of around about $540. Now, that's the minimum price objective. We can still go higher, but we do need to stay above, first and foremost, the 200-week moving average, but also the trend line that I've drawn from this year's lows. Now that trend line comes in round about just above the $500 area. So we can potentially get a pullback to around about the $500 area without actually undermining the upward trend that we're currently in. So as long as we don't fall back below $500, the potential for further gains above $540 remains very much on the cards. So let's have a quick look at the banking sector, because it's a big week for the banking sector this week. We've got Lloyd's latest earnings, which came out this morning, which the markets reacted rather negatively to. And as can be seen from this chart, you can see how much Lloyd's Bank has actually outperformed the rest of the banking sector. The shares are up nearly 70% so far this year. So you could argue how much of the good news is already priced in. We saw the highest level since December 2008 last week. So you have to ask yourself whether or not we could actually see a consolidation above the 70p level, a bit of a pullback after the gains that we've seen in recent weeks and months. And I think the market was a little bit unprepared for the increase in PPI provisions, and as a result we've seen a bit of a pullback in RBS shares as well this morning, and RBS shares have significantly underperformed the rest of the banking sector over the past year or so. You can see the rest of the banking sector share performance in terms of the other lines below. But overall, you can see that Lloyd's has been the significant outperformer. Given the fact that client sentiment remains fairly bullish on Lloyd's, I think significant further upside could be very, very difficult to attain in the short to medium term. Let's move on to currencies. Now, I'm going to look at cable and I'm going to look at Aussie dollar. Now, for quite some time now, cable has struggled around about the 163 area, and as can be seen from this chart here, we've got a potential, it's a potential double top forming, drawing through the highs around about 162.60. The bottom of that double top is round about the 159 area. So we certainly have potential in the short to medium term to fall all the way back to 159 while continuing to keep the current upward momentum in place. If we break below 159, then we could see a very rapid 300-point move lower towards 156. So let's keep an eye on that little envelope of price action between 162.60 and through the reaction lows that we saw in the middle of October, because I think that could be very significant if we get a break either side of that price range. Let's finish up with the Australian dollar daily chart. Now, we've seen the current up move be rebuffed by the 200-day moving average. We've seen last week a bearish engulfing day on the daily candles, and we've seen the Aussie break the uptrend line from the lows that we saw in August. That suggests to me there's potential for further downward momentum to take hold, and we could well see a move towards 93.50, and certainly the slow stochastic on the daily chart does appear to suggest the potential for further weakness. So I think as long as we stay below the 95.80 level on the Aussie dollar, then I certainly think there's potential for further declines. But let's not also forget that the 200-day moving average is likely to act as resistance, even if we do get a rally all the way back to that particular level. Okay, so that's it for this week. Once again, thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.